Hey everybody, welcome to the morning market briefing. It's Friday, August 7th, 2026. Lots to get to today. We've got some earnings reports, but we're going to open up with, some of you've heard this before, but Europeans crying a little bit. The ECB says that they were blindsided, just absolutely shocked to learn that the Treasury was selling euros. They really got their feelings hurt.
Go at it, Tom.
I mean, first of all, it's none of their business, you know? I mean, Ben and I were talking about it today. It's like if a client calls and like, hey, I need to take money out of my account because I want to buy a house, and us being like, you can't do that because
I'm blindsided.
Yeah, because like we manage that money. You can't buy stuff with that money. It's our money, you know? But also like the Europeans do nothing but constantly try and overregulate U.S. companies. And I mean, we should ask Grok what the total number of tech company fines levied by the Europeans on Google, Amazon, Apple, Microsoft over the last even just 5 years would be. I mean, half their income comes from fining U.S. companies unilaterally for some arbitrary rules that they've placed on us. So, Crimea River, I have absolutely no sympathy, and it's our money to spend. We used it. We said, you guys are constantly picking at us and looking down your noses at us and telling us that we need to do X, Y, and Z and have our water bottles have caps that don't come off. Meanwhile, Japan is a friend. They want to make Japan great again, and they're I would argue closest allies in the world, and we're going to use that money elsewhere to help our allies. So, you know, get on board, and maybe we'll buy some more euros. But if not, we'll use those euros to buy some yen. You know, that's life, man.
It's really interesting too, though, just to see like the FT just carry the water for these arguments, and just, you know, all these think pieces, the way that we should think about these things, and they position it so much as like a norm violation. And the reality, I've just asked Grok your question, Tom. We'll see what happens.
Oh yeah, I was about to ask it too.
So it's still going, but we've got some economic data coming through. Do we want to go head there, Ben, or do we want to head to earnings?
Yeah, we can head there because everyone was saying, "Oh, we're gonna have massive inflation because the economy is so strong." And I like, again, like we're not really thinking about the actual underlying data. I think that people are just watching the market, especially a lot of the Fed people who want to raise rates. They're just looking at the stock market and like, we got to get that stock market down. Because if you actually look at the data, and we now have July employment numbers coming through, which are going to get revised probably in a downward direction. And Warsh doesn't really pay too much attention to this, but I'm telling you, this is the type of report that is tailor-made for a rate cut, and maybe multiple rate cuts. Tom, do you want to give some of the numbers, and then I have some color commentary to add?
Yeah, well, I'm not actually looking at the jobs number.
Okay,
I'm still doing this thing, but the total number is
it's minus 23.
Oh, on the jobs?
On the jobs.
I would say 15 billion is the number. Last 5 years combined, Google, Meta, Apple, and to a lesser extent, Amazon, Microsoft, and Uber, $15 billion under what they call the Digital Markets Act and the Digital Services Act penalties and fines from Europe on the U.S.
I was blindsided.
Yeah. Grow up. That's what I say. Grow up, Europe.
On the jobs front, though, do you remember back in May, I think we got the May jobs number, and it was like 150,000, and everyone said, man, the economy is like
trying to hike rates.
Jobs are coming like crazy. Well, that was revised down all the way to 63,000. We knew that.
But nobody talked about it either.
Nobody talked about it. Last month came in at 57,000. That was just revised down to 20. And July, we lost all of those jobs and more. We were actually down 23,000 jobs.
And we were looking for 80,000.
We were looking for positive 80,000. So like net, like we're down probably like 150, maybe 200,000
and
jobs.
And as a reminder, the number now will be restated lower.
Yes. And so
probably by about 80,000. So we're looking at negative 100.
Yeah.
Just for this month.
So if I'm looking at this right now, what I am seeing is that we've seen declines in government. Government was down 53,000. A lot of that was local education. We saw declines in finance on like lending activities. So think mortgage officers, loan officers not doing so well. And then retail as well as some of those jobs from the World Cup come off. So you put all that together and we're seeing some pretty big retraction in more the service side of the economy. And but on the manufacturing side, we're actually seeing some nice acceleration. We went from minus 2,000 in May, plus 11,000 in on durable goods. We went from 14,000 to 12,000 to 18,000 in the last 3 months. And then on the construction side, we've really picked up 2,000 to 5,000 to 22,000 in the last 3 months. So that's all good news. But if I look at the strength of the economy, one way you can look at that is the employment population ratio. So this gets rid of the whole participation rate thing, people dropping out of the labor force, retiring.
It's just what percentage of people are working.
Yes. So we went from 59.6 this time last year to 58.9%. So when Tom talks about we're not at because the unemployment rate fell, figure that one out today. Yeah. We lost jobs, and yet the unemployment rate fell from 4.2 to 4.1. But when we think about what Tom's saying, how the real unemployment rate is higher, like 5 or maybe even 6%, you can quickly get there simply by saying,
well, we've moved 0.7.
We've gone from 59.6 to 58.9 in terms of the percentage of people working. Now, they're not raising their hands wanting to join the labor force right now because they've dropped out, but that's the strength of the economy right now. And I think that's something that we should be taking note of. The other piece of this jobs report is that you also get average hourly earnings, and people are very concerned about, because it's a very tight jobs market, unemployment rate is low, that we're going to have this massive,
or is it
this massive push in terms of higher wages that people are demanding. Well, the estimate was for year-over-year growth of 3.5%. We came in at 3.2%. But probably the more telling piece is the estimate for month-over-month growth was 0.3%, and we got a big fat goose egg. No wage growth over the last month, which annualizes.
We got to raise rates.
Yeah,
which annualizes to 0%.
Yeah.
Right. And so as I look at this jobs report, it just goes to show this is exactly why you don't provide forward guidance if you're the Fed, because things get revised, facts change. Let the market figure this out. And I think the market's going to figure it out correctly. I think right now we have a little bit of a mini rebellion from some of the mainstream old wall Fed watchers, but I think that's actually an opportunity to add bonds. And I would imagine bonds are going to have a very good day today.
We seeing movement yet, Tom?
Yeah, they're big up. I was going to pull up, there's a tweet. I found this guy. He's a portfolio manager. I've just made it way too big trying to zoom in. He's a portfolio manager for like a company called Wellington, and I found him because he was going back and forth with Brian Westbury on Twitter. But he basically put out a tweet that was like everything we've been trying to say about the Warsh situation, but distilled and refined. He goes by at Dr. J Strategy.
The good doctor.
But he basically said, Scott Bessent is saying what most of Wall Street already knows but won't admit. The end of the Fed whispers masquerading as analysts has hollowed out real market thinking. For years, asset prices weren't driven by fundamentals. They were driven by interpretation of carefully leaked signals, trial balloons, and selective guidance. The Fed selective guidance fed to a handful of well-connected reporters. That isn't price discovery. It's narrative management. When journalists become conduits for policy hints instead of interrogators of policy outcomes, markets stop analyzing and start front-running. Wall Street stopped doing objective research and relied on the Fed to spoon-feed them. Wall Street thus never questioned the Keynesian dogma. Wall Street became the lapdog of the Fed. The result is a generation of participants trained to decode tone shifts rather than evaluate capital allocation, productivity, or inflation dynamics. If the Warsh Fed is forcing that ecosystem to operate without a script, the discomfort you're seeing isn't dysfunction, it's withdrawal. Markets can't function without being spoon-fed. Markets that can't function without being spoon-fed aren't efficient, they're dependent. A new era has begun, and some of the cool kids on Wall Street are upset.
Love that guy.
Yeah, I was like, man,
I'm in on Dr. J's
I immediately
strategy.
started following that guy. I was like, this guy gets it. Because this is exactly what we've been saying.
When
just
did
in a
he
more
post
succinct
that
manager.
relative to the Besson tweet?
He posted it yesterday.
Because it's basically a more thorough explanation of the Besson.
Because that was a quote tweet of the original Scott Besson. Nick Timmerhouse is a weenie.
The Besson greatest hits.
Yeah. So, but that's true. That's what we've been sort of dancing around. It's a more succinct way of saying it, but like the market is now, it's up to the market to decide where rates should be. It's not up to the Fed, and the Fed's not going to tell you what they're thinking or doing. And when they do it, it's going to have a bigger impact because no one's going to see it coming. And I mean, rates are already, they're dropping pretty quickly across the board this morning because the narrative that they need to hike rates is deflating very quickly.
I mean, the rate hike in September should be gone. I don't know what, but I mean, that was pretty much a guarantee. That was 102%.
It's at 54% now.
Yeah. And that's got to go.
Oh, wait, just updated 42.
Yeah.
It's going away.
Yep.
Wait till it goes negative.
Yeah.
Yeah.
And the thing is, they're probably reacting too strongly to this jobs number because it is wrong.
Yep.
Yeah. And
we know that.
But I mean, you think you put this jobs number together with the inflation numbers that we've actually been getting, that the actual inflation numbers, by the way, are not as severe as what the Fed people are talking about the inflation numbers being.
Yes.
Like it's just totally different. Like everyone's saying inflation's rising. There's no data that support that. Today's data doesn't show that. And by the way, they're going to revise.
Yeah, we're getting new formulas.
Yeah, how they do the PCE, which Elizabeth Warren is not. She's already like summoning all of her people to have an inquest into the Fed on how they're changing the PCE calculation. But basically, the core PCE inflation number, which the Fed has historically used, which comes out on a 45-day lag, by the way.
Super helpful.
They use, so they have to make guesses on where certain prices are. And so on the software side, they actually benchmark it off of hardware. They've historically benchmarked it off of hardware. But the problem is, over the last year, you've seen hardware costs absolutely spike because of all this demand for data centers. And what a lot of the people who calculate these PCE numbers say is PCE stands for personal consumption expenditures.
How many memory chips have you bought today?
I haven't bought a data center in a while.
and specifically classifying that as software. So what they're doing is they're devaluing some of that element of it and increasing the value of like things like video game software and things like that. And so that's going to have about a 10 basis point reduction onto your PCE number. The other thing that's going to reduce your actual reported PCE number going forward is a recalculation how they compute portfolio management services and inflation there. And so what they're going to do is, instead of talking about assets under management, so that's basically how they figure out portfolio management inflation. If the market had a great year and was up 20%, they'll say, well, portfolio management fees are up 20%, therefore we have 20% inflation
in that category.
And this is why PCE inflation is so much higher than CPI inflation. And so what they're trying to do is get something what actually people are paying, what is underlying inflation. And so they're recalculating that and constituting that based on a formula based on firm.
I mean, the portfolio management piece is something I'd never really thought of in terms of being a factor in their calculation. But for context, for those that are not in our industry, there is quite a bit of chatter and concern in our industry, for instance, about fee compression. People that own advisory firms that bill on an assets under management basis are saying it's getting more and more competitive to price these things to where we're profitable to the level that I want to be profitable, because fees are literally coming down as a percentage of what you're managing.
Yep. Exactly. And I think so that's going to have a downward impact on the PCE inflation for the month of August, which will hit in mid-September. And so you put that together with a weaker jobs number and you're going to have lower inflation. And I think with oil prices they are lower than they were a couple months ago. They continue to be volatile even today. But I mean, it just goes to show, don't bank on what anyone is saying about rate increases at any single point in time, because the facts are going to change.
Mm-hmm.
And I think that's important to remember.
Let's talk some earnings, Ben. Biggest takeaway I have tonally Big movements.
Big movements, and just kind of as it affects equities that we own. Microchip is a harbinger in the semiconductor space. They're up 9% today. See a lot of strength in industrial and auto. We own analog devices in this space, ADI, so they're going to benefit from that as well. Not to the tune of 9%, but they should do fairly well today as a result of this. Then we have some companies in the software space, Atlassian and Cloudflare. Both have been really hit because of this idea that software is going away and that it's all going to be agentic and it's all going to be AI. Atlassian said AI is the best thing that's ever happened to the company. Atlassian competes with ServiceNow, which we also own. And both of those stocks are well below. They're down year to date. So this is going to be good for both of them. Atlassian up 30% again. And then Natera.
ServiceNow only up 3 pre-market. That's sad. I need
For now,
30.
for
Love
now.
30.
It's breaking over 120 right now.
It's been on a run, though.
Yeah. I mean, it is up, 35%, 40% from where it was just a month and a half ago.
Yeah, I mean, it got down to $91. It's at 117. Going to open at 121.
So can't hate that. Wish they could all be like that.
Yeah.
And then Natera, which we own for some more risk-tolerant clients at small weights, is up 15%. They provide a lot of testing, especially genetic testing for cancers, and they're up 15% pre-market. That's one where the valuation doesn't quite work anymore, so we might even be trimming into that strength. But good news is being rewarded by the market, and it's really the market's behaving as it should right now, and I think that's the biggest takeaway from these earnings reports and from the jobs report that we just had. This is exactly how you would expect that jobs number to be interpreted. This is exactly how you'd expect those earnings results to be interpreted, and I think that's good news. Especially, it's good news from an analyst perspective because it means if you get the analysis right, then you can get a lot of other things right.
Yep. We got the official announcement on Terafab. Most notably, I would argue that it is going to be stunningly beautiful, according to Elon. 100 million square feet. This thing's going to be a monster. Grimes County.
I mean, you're going to be able to see it from space, right?
It's going to be massive.
So big.
SK Hynix also rolling out $38 billion of investments into new capacities. I mean, these stories aren't going away.
I think the biggest thing here is that memory chip prices are going to come down. And you've not only more capacity being added, but you also have companies that are explicitly trying to become more efficient in memory usage. There was a big headline out of NVIDIA yesterday saying they want to reduce the amount of memory in their chips, in their GPUs, and that's going to bring Micron margins down. That's going to bring the inflation in those areas down as well.
Last story for the week, talk Putin a little bit. Don't want to make Hicks too nervous, but U.S. intel finding that Putin might try to test NATO's resolve. Maybe we'll do another incursion. Maybe we'll get a little further out there.
Yeah, I don't know how much weight to put in this. I'd be interested to hear Tom's thoughts on it. I think the most relevant thing here is that it's both happening under the Trump intelligence regime. Earlier in the year, they did not think that Putin would try to extend beyond Ukraine. Now let me get the exact wording.
Well, they haven't even gotten Ukraine yet.
Yeah.
Let's finish one thing before the next thing.
Apparently that assessment changed earlier in the year as Putin is increasingly squeezed in Ukraine and under pressure at home to secure a victory. There's intelligence that thinks that they could have more incursions into like Poland and Romania. To me, that's kind of at odds. I don't understand the logical progression there, but that's the reporting.
We got to win this one. Let's start another.
Yeah.
Man, I don't know. Poland, I think, would be a much tougher fight than Ukraine. At least, certainly modern day Ukraine, which is mostly just rubble.
Yeah, I wouldn't want to fight them.
Yeah. You know where the Polish keep their armies? In their sleeveys.
Next week, I'm interested in small business optimism. I feel like as we have gone through earnings report, as we've digested new economic data, regardless of how legitimate the jobs report and other things may be, it certainly seems like we're getting to a more favorable backdrop. I'd like to see that coming through on the survey data. We'll get CPI on Wednesday, PPI on Thursday.
It's so refreshing to be able to actually genuinely say that, though.
Yeah.
That you're more concerned with what's actually going on with small businesses in America than what some person behind a computer
Than
desk
what
and
Nick
an Excel
Timmerhouse
file
thinks.
is saying on CPI. Yeah.
Yeah. Good stuff. All right. Wrap it up there. Y'all have a great weekend, and we'll talk to you Monday.